When a first real estate investment fails, the explanation that gets offered is almost always about timing. The market turned, the interest rates moved, the tenant was bad, the neighborhood changed. These things happen. They're real, they affect outcomes, but they're rarely the primary cause of a first-time failure. The primary causes almost always appear before the acquisition closes, in the underwriting, in the assumptions, in the steps that got skipped because the deal felt right and the process felt like a formality. The first structural failure point is the pro forma, not the market, not the tenant, the numbers that were built before the deal was done. First-time investors build pro formas from the information the seller provides, the current rent roll, the expense history, the occupancy data. And those numbers, presented by someone motivated to sell, reflect the best version of what the property has produced. Not the realistic version, not the stressed version, the version that makes the deal look attractive. Vacancy at the lowest it's been, expenses at the lowest they've run, rent at the top of what the market supports. And the investor, new to the process, builds their analysis on those numbers, without independently verifying them, without stress testing them, without asking what happens if even one of them is wrong. The second structural failure point is the physical condition of the asset. A standard inspection identifies what's currently wrong. It doesn't identify what's about to go wrong. The roof with 3 years of usable life, the HVAC system on borrowed time, the plumbing that passes inspection but will fail within the ownership period. First-time investors treat the inspection as the end of the physical evaluation. Experienced investors treat it as the beginning. They bring specialists, a roofing contractor, an HVAC technician, a plumber, not to find reasons to walk away, but to build an accurate picture of the capital expenditure timeline the asset is going to require, and to price that into the deal, or negotiate accordingly before the acquisition closes. The third structural failure point is the market assumption. Most first-time investors underwrite to current market conditions, current rents, current vacancy rates, current comparable sales, as if those conditions will persist through the holding period. Markets move. Rent growth assumptions that seemed conservative can prove optimistic if local employment shifts or new supply enters the submarket. Vacancy assumptions built on peak occupancy can prove wrong in the first year of ownership if the tenant mix changes or a larger competing property opens nearby. The investor who underwrites to current conditions without examining the direction of those conditions, who doesn't ask whether rents are at the top or bottom of a local cycle, is underwriting a static version of a dynamic reality. These three failure points, optimistic pro forma, incomplete physical evaluation, static market assumption, are structural. They're not bad luck. They're not timing. They're the result of a process that was abbreviated, that trusted seller-provided information, that treated inspection as sufficient, that assumed current conditions would persist. And they're visible in hindsight, almost universally, as things that could have been identified before the acquisition closed. Not always in time to change the decision, but in time to change the terms, to negotiate a lower price, to build a larger reserve, to structure the deal differently. The market didn't cause the failure. The process that missed what was already there caused the failure. And the market just made it visible. If this feels familiar, if you've felt this pressure but never had words for it, this channel isn't here to motivate you. It's here to help you see clearly. If that resonates, like the video, subscribe. More clarity is coming. The most expensive mistakes in real estate aren't analytical errors. They're emotional decisions dressed up as analysis. They follow predictable patterns. They feel like logic from the inside. They look like something else entirely from the outside. And they almost always appear at a specific point in the process, after the investor has decided they want the deal and before the due diligence is complete. The first emotional pattern is anchoring to the vision. A first-time investor visits a property. They walk through it. They start to see what it could be, not what it is. The renovated version, the full occupancy version, the version where everything the seller implied turns out to be accurate. And from that moment, the analysis shifts. It's no longer an objective evaluation of whether this specific deal produces an acceptable return under realistic assumptions. It's a search for confirmation that the vision is achievable. Numbers that support the vision get accepted. Numbers that challenge it get explained away. Concerns that arise during due diligence get minimized because the vision has already been built and the analysis is now working in service of the decision rather than informing it. The second emotional pattern is loss aversion at the wrong moment. A deal has been under contract for weeks. Due diligence has been ongoing. Time has been invested. Deposits have been made. And then something comes up. A structural issue, a discrepancy in the numbers, a problem the inspection revealed that changes the economics. And instead of renegotiating or walking away, the investor absorbs the new information and continues anyway. Not because the deal still makes sense, because walking away feels like losing everything that's been invested in the process. The time, the energy, the professional relationships engaged, the mental commitment to the outcome. Loss aversion, the behavioral tendency to feel losses more acutely than equivalent gains, keeps people in deals that the numbers have already told them to exit. The third emotional pattern is social validation pressure. Real estate decisions rarely happen in isolation. Advisors are involved, agents are involved, family members have opinions, friends have been told about the deal. And the investor, who started the process as the decision maker, gradually becomes the person managing everyone else's expectations about what they're going to do. Walking away from a deal that everyone knew about, that was discussed at dinner, that the agent has been working on for weeks, feels different from walking away from a private decision. The social context creates pressure to follow through, not because the deal is right, but because reversing course feels like explaining a failure to people who were watching. These patterns aren't unique to real estate. They're how human decision-making works under conditions of commitment and visibility. But in real estate, where the stakes are high, the transactions are slow, and the commitment builds gradually, the emotional patterns have particularly significant consequences. The deal that gets done because the investor was anchored to a vision, because walking away felt like losing, because everyone was watching, is the deal that performs worst. Not because the market failed, because the decision-making process was captured by the wrong inputs before the acquisition closed. Due diligence is the part of the process most first-time investors treat as a formality. The deal has been found, the price has been negotiated, the contract has been signed. Due diligence feels like the administrative phase, the steps that confirm what the investor already believes to be true before moving to closing. That framing is wrong, and the cost of it is visible in the outcomes of first-time investments more clearly than anywhere else. Rigorous due diligence is an independent investigation, not a confirmation of the seller's narrative, not a search for reasons to feel comfortable about a decision already made. An independent investigation into whether the asset is what it appears to be, and whether the deal produces what the analysis assumes. That means verifying every number the seller has provided. Rent rolls, verified against actual lease agreements. Expense history, verified against actual invoices, not summaries, invoices. Occupancy history, verified against actual booking records. Tax and insurance costs, verified against actual bills. Not because sellers lie, because sellers present the best version, and the best version is not the same as the operating reality. Physical due diligence goes further than the standard inspection. The general inspection identifies what's currently wrong. Rigorous physical due diligence identifies what's currently wrong and what the capital expenditure timeline looks like for the next 5 to 10 years. Specialty contractors assess the roof, the HVAC, the plumbing, the electrical, not to kill the deal, but to build an accurate capital expenditure model, so that the reserve requirement is sized correctly, so that the cash flow assumption accounts for the capital expenditures that the asset will require, not the ones that appeared in the last year's expenses. Because assets don't require capital expenditures on a convenient schedule. They require them on a physical schedule, determined by the age and condition of the systems, regardless of what the previous owner chose to budget for. Market due diligence examines the direction of conditions, not just the current state. What is the supply pipeline in this submarket? New apartments being permitted, new competition being built, developments that will come online within the next 2 to 3 years and affect occupancy and rental rates. What is the employment base? Is the local economy diversifying or concentrating? Are the major employers in the area expanding or contracting? What is the regulatory environment? Are there rent control discussions in this jurisdiction? Short-term rental restrictions? Zoning changes pending that would affect the asset's use or value? None of this is visible from the listing. All of it is discoverable with the right research in the right time frame before the acquisition closes. The investors who perform rigorous due diligence don't kill more deals than those who don't. They make different decisions about the same deals. Some deals that would have closed don't close because the due diligence revealed something that changed the economics. Some deals close at lower prices because the due diligence revealed a negotiating position that the seller's narrative had obscured. Some deals close as planned because the due diligence confirmed that the asset is what it appeared to be. The process produces information, and information, used correctly, produces better decisions than confidence in a narrative does. The first-time investor who treats due diligence as a confirmation step is missing the entire point of it. It's not there to confirm. It's there to reveal. And what it reveals before the acquisition closes is the only thing that can actually change the outcome that follows. If this shifted something for you, subscribe. Like this if it clarified something.